Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek, insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec on Bloomberg Radio.
President Donald Trump planning to impose 25% tariffs on all U.S. imports of steel and aluminum, broadening his trade restrictions to some of the country's top trading partners and seeking to protect domestic industries here in the U.S. that helped him win battleground states last year, which made us want to know a lot more about those markets in the U.S., how much we import or export, and really, Tim, the cost of a trade war, tariff war here.
Okay, so we start with U.S. markets in steel and aluminum. And Bloomberg News metals and mining heavy machinery reporter Joe Deaux, who joins us here in the Bloomberg Businessweek studio. Joe, let's start with numbers.
Yeah.
How much steel or aluminum does the U.S. actually produce right now?
U.S. produces about 90 million tons of steel and nearly 3.5 to 4 million tons of aluminum.
Okay, put that into the context of what we use versus what we import.
We use about 90 to 100 million tons. So steel's kind of like made to order. Yeah. That's the way it works. Aluminum, not the same situation. We produce, what did I say, 3.5. We're consuming double that. But, 50% of what we consume comes from Canada.
Okay. You mean our trading partner?
Like our biggest trading
You
partner.
saw that Ontario ad yesterday during the Super Bowl?
Yeah, that's right.
Yeah, I was thinking to myself, when did they, put that into the mix?
Well, I thought it was an interesting mix overall. So what is the impact of these tariffs? So it sounds like, let's take steel first of all.
Sure.
Is it a problem?
Well, it depends on who you ask. If you ask the steel makers today and the service centers who buy the steel from them and sell to the consumers, they're going to say, no, this is not a problem.
Stocks are rallying.
This is good for our profits. We want more domestic produced steel. And so this will give us the runway to feel confident that we can make more mills or produce more and have hefty profits from doing so.
How quickly do we do something like that? I think about all of the, fracking craze and the drilling, and you go up to, the west of the United States. We're like, we've seen these boom and busts before. So how quickly, if that's the case, can you actually build out the facilities to ramp up?
Yeah, listen, if you're just building a new electric arc furnace now, which is your typical kind of steel mill in the United States, realistically, you're probably talking 2 to 3 years, depending on if you have any tie-ups. Like making a manufacturing plant, it's not like, just like producing toys from Mattel that go on the shelf. Sometimes you start building a plant and things go wrong. And there's only 2 consultants you can deal with. And so it might take longer. I mean, we saw this with Steel Dynamics. They had a mill down in Texas that they spent years. It's fine. It's doing fine now, but it took a year or 2 longer than I think people were anticipating. I think the bottom line is it's a 2 to 3 year time span. There are not a lot of plans right now to be building out a ton of new mills. There is obviously
steel or aluminum.
Well, definitely not aluminum, right?
Yeah.
So actual aluminum plants that make primary aluminum, there are plans, no plans to build new aluminum. There hasn't been a new aluminum mill plant built in the United States in 40 years. What they do build in the United States are something called re-rolling facilities, where they buy already made metal, they melt it down and turn it into products. We do have a couple of new ones of those coming online because, listen, there's really good demand in the packaging space and can making, and the automakers are always going to be on high demand. But listen, it's also not clear, what is the intention of the tariffs? Mm-hmm. I think the intention that Donald Trump's going for this time around is the idea of bringing more manufacturing back to the United States or having others build new plants in the United States.
But as you mentioned, the timeline on that is not even close to overnight.
Right.
So could these actually accomplish that goal?
Long term, yes. And I know this is a crazy thing for us all to think about, but in my world of metals and mining, where timelines are years, not months,
right?
They do say, listen, if we want a chance in certain production industries, we do need the timeline to say, we can do this in 3 to 4 years. If you put things like tariffs in place that give us the confidence that when the thing is finally done, we'll actually be profitable because the prices are going to be fair across the board.
Well,
that's what they argue.
FYI, in 2 years we have midterm elections. In 4 years we have another presidential election. A different president could come up and say, let's assume these tariffs last, could say, no more tariffs. So I'm wondering from a steel company's perspective, or someone who might create, go back to aluminum production here. I mean, how are they gaming this out to say, do we make the bets to do the build?
There are some really profitable steelmaking companies. Like Nucor Corporation is a great company. Steel Dynamics is a great company. They might be sitting there today saying, cool, this gives us the cover to feel confident on some of these other projects that we've had in the pipeline that we haven't talked about.
Right.
Do look like good bets going forward 5-10 years. I don't know for sure, but they could be having that conversation today. What
does it do to the steel and aluminum that we import to use?
Well, we're going to anger a lot of foreign producers. We import a lot of aluminum and steel from the United Arab Emirates, Brazil, Mexico, and Canada, right? Like, they're not going to be happy about this. They have major questions and concerns. And of course, buyers, right? They're going to have to pay more. If you're buying steel right now, which people aren't. There is no spot activity happening in the steel market right now. They're just taking contracted metal. Suddenly you're telling them they're going to be paying, $150 per ton more? They're not going to be happy about that. Inventories across the United States of steel right now are the highest we've seen in years.
Why is nobody buying it?
The demand's not there. Remember, interest rates are still high.
Right.
Costs are still high. The construction industry is getting absolutely torn up. And the construction industry is one of the great demand industries for steelmaking. So what? You're going to go and you're going to add these tariffs? It's not going to suddenly spur consumption in the construction industry.
That's what I was kind of confused about, the rally that we're seeing in all of these material stocks, the aluminum producers. Because I'm just kind of like, well, wait a minute.
They've been really battered. They've been really,
why?
Yeah, they're really battered. One of the major steel index, the S&P sub steel index, dropped by the most in 2024 since 2018. It was a terrible year. Interest rates are still there. Inflation is still a problem. And when you talk to these metal making industries, they're the bottom line cost, right? And so if their consumers are sitting there saying, just financing is way too expensive right now, we're not going to move forward with the project that we had in the pipeline, then, that's bad news.
Is this a commodity in the sense of the steel and aluminum you get from U.S. producers is the same as the steel and aluminum you get from producers outside of the U.S.?
Yes.
Do customers care where it comes from apart from price?
For the most part, no. Now, when you get into products, you get into very specific types of steel products and types of aluminum products, they do care because that is a value add. But if you're just talking raw steel making and primary aluminum making, I've heard this since I started covering this stuff 10 years ago. The Chinese do it just as well as the Americans. Everybody figured out how to make great steel forever ago. The chemistry's there. Yeah. Now, the steelmakers will say, no, but our steel, this is an alloy. It is particularly better. But if you talk to actual consumers in the market, they're like, no. Like, maybe I like the buyer who I'm buying from. I like doing business with them. But like the steel itself, they all pretty much do it pretty well.
How do you think about trade agreements and where we buy things like steel or aluminum from, and what that means geopolitically and those alliances?
I think in 2016, we respected these alliances. It was part of the post-World War II union, of the world. The West kind of said, listen, soft power is important in these open markets, lead to more efficiency and better profits across the spectrum. But I think Donald Trump changed the calculus. And I think he took a page out of the steel maker trade book, which is some people do cheat. They dump and they add subsidies to whatever they're trying to sell. And in that regard, it is unfair. So today, I think that's where this conversation is now, right? Is like, well, do we care about the alliances? Sure. But we also have to make sure that things are fair on the trade level. That's the thinking.
One more context question. How big, in terms of number of employees or just size of the economy, what do we need to know about the steel and aluminum industries?
I think the best way to think of it is industrials. The industry part of GDP is 10% of GDP, right? So like when I'm sitting down on the weekends and I'm talking to my friends who are in tech or finance, like I'm a blip on the radar talking about steel and aluminum, but it is still a critical building block of the economy.
Is this a critical moment in time where things are going to change in terms of potentially aluminum and steel production in the U.S.?
I don't know. I mean, listen, he did this in 2018. We were producing 81 million per year. We're currently, or 82 million per year. We're currently producing 81 million. Nothing changed.
All right. Good to know. Some great context as always. Joe, thank you so much. Joe Deaux, busy day for him. Metals and mining, heavy machinery
Joe
reporter.
Deaux is so metal. I just wanted to say that.
Do you play, do you have a guitar? Do you have a band? Do you have a metal band?
Piano.
All right, take it back.
Forget about that.
Take it back. He's not metal.
All right. You asked, though, about kind of the economics of this, and we want to stay with this subject and get into the possible economic impact on the U.S. of it all, and how economists are reevaluating the impact of Trump's policies on the U.S. economy, warning that the risks to growth are front-loaded and rewards may not be visible, Tim, until next year.
With that side of the story, back with us is Bloomberg News global economy reporter Enda Curran. He joins us from our Washington, D.C. bureau. Enda, good to see you this afternoon. Well, if we think back to the first Trump administration, there was also tax cuts and there were tariffs. This time there are tariffs without tax cuts. What do we need to know about that?
Yeah, it's the sequencing of the policy rollout and the pace and maybe breadth of the policy rollout that's unsettling some economists. I mean, on paper, of course, President Trump's agenda promises to unleash the kind of regulation that holds back investment in infrastructure and extraction of resources and energy, for example. He wants to push through tariffs that are all part of a bigger game plan to create investment in manufacturing at home and create more jobs, and of course push through tax cuts to relieve households and businesses. But economists are saying that's fine on paper, but right here, right now, things are moving pretty fast on the tariff front. There was a threat of tariffs against Colombia. There was a threat of fairly punishing tariffs against Mexico and Canada. That came pretty quickly and surprised a lot of people, because you're talking there about impacting a consumer goods basket. Think about the food and the veg that the US buys from Mexico, for example. Then there are tariffs already in place on China, and they're new in the sense that they are across the board on all tariffs, not just, say, targeted for national security or targeted on intermediate goods. It's across the board, everything coming in 10%, and China has retaliated. And then at the same time, we've lots of focus, of course, down here on the spending cuts, on the agency closures, on the federal staff layoffs being pushed through by Deaux. Question marks there over when that ends and how it impacts overall. And we have deportation going on, which of course is another variable when it comes to the labour market. So you put it all together, a lot of economists are saying, okay, we get the positive agenda here, but right now this feels pretty bumpy, and they're wondering how it all stacks up in the end.
I mean, and let me go there, Enda. How difficult is it at this point to really kind of figure out the economic impact?
Yep, so obviously, absolutely right. We're at the start of the administration, so it's very early in all of this. But we are seeing some tangible impacts. Now, take, for example, the tariff debate, which dominates so much of the economic news right now. We have had the University of Michigan survey showing that consumer inflation expectations have risen sharply, and that's linked directly to the tariff story. And the tariffs, of course, being the threat of duties on the kind of typical consumer goods coming out of Mexico, less so from Canada, but certainly from China. So there has been an impact there. Secondly, we have plenty of businesses, importers, manufacturers making warnings, making the point that these tariff threats are impacting, disrupting their supply lines, disrupting their plans for investment. They don't yet have certainty in terms of what will the duties be, what will be impacted, when and by how much. So there's a source of uncertainty there, and of course beyond that, you have now these job layoffs in the federal sector and agencies. So there is some real world impact.
It's a lot of moving parts. You know, one thing I do think about, and I think about from your perspective, is we are a global economy, and what happens often in one developed major economy impacts others. As a global economic reporter, what's at stake for the U.S. if its neighbors or trading partners or global allies are hurt economically by these U.S. tariffs? I mean, what's at stake in terms of U.S. growth, global growth, and really then geopolitical stability?
Yeah, so the US has been the standout performer for the world economy over the past few years. Germany is in the doldrums. China's economy is sluggish, and when you look at the observations from, say, the IMF, for example, they made the point that the US is the world leader for growth. It's driving the world economy. It's the reason it upgraded the global forecast this year. So that's important in terms of supporting the overall world economy. Secondly, if we go down the road of the US getting involved in a kind of a tit-for-tat trade war with key trading partners imposing tariffs on each other's goods or other kind of restrictions, then obviously that will start to weigh on business confidence, business sentiment, business investment, maybe eventually employment. There are certainly risks in going down the road of a hawkish trade policy. Of course, Trump administration says this will ultimately drive investment at home.
All right, going to leave it on that note. Yeah, certainly something to think about. That global investment, right, potentially here into the United States. Enda Curran, global economy reporter at Bloomberg News, joining us from our D.C. bureau.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, well, the state and local government debt market is poised for another strong year in terms of issuance and demand from retail buyers, provided federal lawmakers maintain the bond's tax-exempt status. This is according to investors and bankers, Tim, who took part in a Bloomberg panel discussion that was late last month.
Meantime, the Bloomberg Muni Bond Index is up just under 1% so far this year. With some thoughts on the Muni market as well as a Super Bowl tie-in. Yes, there's a Muni connection to everything. We're going to get to that in a moment. We welcome Dan Close, head of Municipals over at Nuveen. It's got $1.3 trillion in assets under management. Dan joins us from Chicago. Dan, we're going to talk stadium financing in just a minute, but we got to talk the tax-exempt status of Muni bonds, because I'm wondering if you think the Republican Congress will eliminate the tax exemption to help pay for the extension of the Trump tax cuts.
First, thank you so much for having me on the program here today. Certainly this time around, there is, I think, a threat to the Muni exemption that we haven't had in a long time. And so if you look at all the payers that need to go in and roll the Tax Cut and Jobs Act, the House Ways and Means did put out potentially all 50 or so different payers, and municipal exemption, at least specific to hospitals, private activity bonds, we're on that list. So we're certainly watching this, we're monitoring it, but I think given that all of infrastructure in the United States is financed at a local level with the Muni exemption, our estimates $826 billion in savings over a 10-year period for the exemption for your local high school, your local water and sewer authority. We think we end up okay, but certainly it's going to be a fight to keep the exemption this time around.
But safe to say, all right, so it is a defining feature of the $4 trillion asset class. So what would it do to the Muni market if that exemption goes away?
Yeah, sorry to cut you off. It would certainly raise the cost of any of your projects. So if you're a local school district, your high school's overcrowded, you need to go in and issue debt to go in and to finance a new high school. If all of a sudden the exemption went away, you're going in and financing that local infrastructure at a taxable level. So we estimate that's another 200 basis points, 2% of higher financing cost if that were to go away. So all this local infrastructure projects, we think could get a lot more expensive if the exemption were not to be rolled.
So let me just ask one follow-up to that. So
Sure.
Potentially that could, if it's a higher cost to do this project, it's more financial stress potentially on municipalities, right? Or is it a case that projects don't get done because the cost has gone up? And I think about the economic impact of that.
Yeah, and I think it could certainly be both. Projects that at the margin become too expensive don't get done. We saw that in 22 and 23. There was a bunch of airports that were up on the block to go in and to have expansions. When materials became too much, when the cost of inflation was up, we saw some of those projects get deferred. And in the similar way, if it does become too expensive, some of these critical infrastructure projects could be delayed, or at the very least, become much more expensive, and that would put some stress on municipalities and their finances. So
it could be an economic impact, right?
Certainly. And I think anytime you go in and raise the cost of just providing, essential service infrastructure at the local level, it could very much have an economic impact. And we're certainly trying to make the case, every congressperson has a home district. Mm-hmm. We're making the case of all the different projects that are being done and financed in each congressperson's home district and how much more those projects could cost if, in fact, the exemption did go away.
Well, on that point, is Nuveen specifically lobbying Congress to keep the tax exemption for munis?
Yeah, we're having conversations with our government relations folks, which is more at the state and local level, and just reminding everyone in Congress again of all the different ways that muni finance does go in, help their district, and we think with such a narrow majority in the House, with two very supportive members on the House Ways and Means, will ultimately prevail. But in 2017 with the Tax Cut and Jobs Act, the muni market had to give up pre-refunded bonds. And it might be the case that private activity bonds issued by healthcare providers, higher ed, for instance, might go in and have part of their exemption chipped away as a potential payer.
Hey, Dan, how do you look at the involvement of the federal government with different states when it comes to munis? For example, California and New York, huge when it comes to muni issuance, but right. Donald Trump, not a big fan of the way that these states are run. He's been outspoken about that. What's the risk factor there?
Yeah, I mean, the Trump administration, just by our own history, was very supportive of municipal bonds and of the market during its first term. If you look at by the numbers, $4 trillion, Carol, was the number you had mentioned as far as the size of the market. That's roughly divided fairly equally between red states and blue states as far as what amounts of bonds are outstanding. So certainly, despite anyone's political leanings or states leaning one way or another, certainly every local government, every state government is availing themselves of this exemption and is certainly using that. So, we don't think that the administration is hostile towards munis in any state in any way. We think they see the benefit of going in and having infrastructure choice, if you will, that infrastructure decisions are made at a local level. And I think that really is fairly congruent with what we understand that this administration is trying to accomplish.
Hey, we're kind of working our way across the country with you. Got a question about Nuveen and if it has plans to buy high yield bond being issued to help finance Brightline West. That's that high speed rail line that's going from Southern California to Vegas.
We are taking a close look at it. We just had the bankers in, the issuer into our office just last week. We're taking a close look at it. We've certainly been a supporter of Brightline East in Florida, and certainly are taking a close look at this deal, which should be coming in the next couple of weeks.
Okay, well, let's talk stadium financing when it comes to munis in the wake of last night's Super Bowl. Just how much are munis involved when it comes to stadium financing around the country right now?
Yeah, very much so. I mean, there's currently an ask of about $13 billion or so in stadium financing by 12 different municipalities. And just taking a step back, it's not going to finance, the scoreboard. It's not going to finance actually inside the stadium, the turf on the field. Most of that is all privately raised as far as actually building the stadium itself. Where munis come into play is just all the wraparound financing. I'm here in Chicago, huge Bears fan. The Bears are asking for $2.4 billion for their new stadium on the lakefront, but none of that is really for the stadium itself. It's for public transportation, a new bus depot, extending the water lines, the sewer lines, extending all of that critical infrastructure in order to actually build the stadium. So we're seeing a lot more asks of municipalities to go in and to help finance that wraparound financing before the stadiums do come in.
All right, this was really cool. The muni market, a massive market. I feel like we covered so much ground. Dan, come back soon. I hope we can do that.
Thank you so very much. I do appreciate it.
All right, same here. Dan Close, head of municipals over at Nuveen, $1.3 trillion in assets under management. As we know, munis, about a $4 trillion market, so massive. Dan joining us there from Chicago.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Well, shares of the $28 billion market cap fintech company Broadridge Financial Solutions hitting an all-time high today. Broadridge provides infrastructure for capital markets. They do wealth management, corporate governance, and more. The company did report earnings at the end of last month. They reported revenue and EPS for the second quarter that came in above estimates. The company also reaffirmed its adjusted earnings per share forecast for the full year. We've got with us Tim Gokey, CEO over at Broadridge. He joins us from New York. Tim, explain exactly where Broadridge plays in the market.
Yes, well, thank you. Thank you for having me today. And Broadridge is, we have a unique position because the real core of what we do is a network that connects every individual investor to every public company, to every wealth manager and every fund, all around the topic of corporate governance and communications. And that it gives us a unique vantage point at the center of capital markets, wealth management, and corporate governance. And we did have good results in the quarter with recurring revenues up 9%, earnings up 70%, but we're a bit of a seasonal business and there's some timing in there. So we reaffirmed, as you said, earnings of 8 to 12% for our full year, which ends in June. And also that we expect to meet our 3-year guide, which ends a year from June. I think what's...
Yeah, Tim, I just want to jump in. How dependent are you on companies IPOing?
Most of our business is ongoing and it's around companies that are in business today. So when there are IPOs, that's a good thing. That makes more companies and it's helpful. But it's our business is not dependent on that. It's a nice tailwind when it happens.
Hey, one of the things I want to ask you, Tim, you said, this unique vantage point that you have into capital markets and wealth creation. So tell me that unique vantage point, what it does tell you about what's going on in capital markets right now, what you are seeing or what it is you're seeing in terms of investor psyche and what you're seeing about wealth creation.
Absolutely. I think we're really seeing an ongoing revolution in how people invest. And I think there are really 3 trends behind that. One is increased participation. We're definitely seeing that in our numbers with the number of positions that shareholders hold up by double in the last 5 years. The second one is increased access to more products, more financial products. We're seeing that with liquid alternatives, with managed accounts, but especially now with crypto and where that is going to go over time. And the third is really there's an increased interest in governance and getting involved in what large companies are doing, especially among younger people.
What does governance mean, especially in an environment where when it comes to factors like ESG or DEI, diversity, equity, and inclusion, you are seeing companies roll back on that. And, it certainly, I think it's safe to say that folks would say they're taking their cues from society, but really from what's going on in the federal government. So what does that really mean, increased governance?
It is, shareholders have an opportunity each year to vote for the board of directors and for proposals that come forward. And most companies have their annual meetings in the few months that are just coming up. We're just beginning the proxy season between now and really the end of May, as when most companies will have elections, and shareholders have a chance to weigh in. The number of proposals, especially around ESG matters, peaked a couple of years ago. And also support for those proposals a few years ago was as high as 40%. It's been coming down over time. Last year, it fell again, both the number of proposals and support specifically for ESG. So shareholders do have the opportunity to make their voices heard. And I encourage everyone listening to vote when they have that opportunity. I think a real innovation that's happening, though, is that fund companies are saying, we don't want to be in the business of voting on behalf of our shareholders. We want to push that opportunity back to the shareholders themselves. And that is something called voters' choice or pass-through voting. We did that for 8 funds 2 years ago. We did it for 100 funds last year. And this year is going to be more than 400 funds. So that's a rapidly growing trend of giving people the opportunity to vote not only on the companies they hold directly, but if they own a mutual fund, the opportunity to weigh in on the decisions for those companies as well.
I am very curious about crypto. You mentioned it, and you said that we'll see what happens. You basically said, we'll see what happens with crypto this year. What do you think happens to crypto this year?
Well, there's obviously a lot of investor interest in that, and there's been a lot of challenge the past few years where really it's a new asset class. There needs to be a strong framework around it so everyone understands how to play, and that hasn't happened the past years. It's just been really enforcement, but against unclear rules. And I think the new administration is very committed to working with Congress to put in place a clear set of rules and guidelines around crypto. And we think the key to this, if you think about the growth of other recent asset classes, take ETFs, which are huge today, They were nowhere 25 years ago. One of the real things behind them was good disclosure for retail investors. And ETFs took the disclosures that were that were mutual funds were already using. They adopted that same framework. And we think that adopting a similar sort of disclosure framework for crypto assets could be something that would really allow people to invest in it with much more confidence.
In general, how do you see the new administration and policies that might come out? I think businesses initially think it's going to be an easier regulatory environment, much more business friendly. But what does it mean specifically for Broadridge?
Yeah, I think for Broadridge, it's probably not as big an event as it is for many other companies. Certainly, there's a lot of optimism about capital markets, about the direction of the economy, and M&A, and those things are all mild positives for us, as you asked me about the question about IPOs. So it's a positive. When you think about the biggest priorities of the administration around taxes, tariffs, immigration, cultural issues, those are pretty neutral to what we do. And then there's a set of issues that are specific to financial services that are not nearly as much administration priorities, but I think there will be change. Crypto is probably the highest on those, which that is a more important one. I think there is also interest around shareholder engagement and how to get that right, as well as how to continue digitization in the economy.
So how is your company preparing for...
Those things we think are all positives for Broadridge.
So how is Broadridge preparing for an onslaught of crypto customers? And how would they use you as a client?
Yeah, I think for us, the biggest area is around, what we do is helping have clear disclosure of what is the risk and return for your different investments so that investors can make their own choice around risk. And with crypto, one of the challenges is there's no real one source of truth because it's decentralized, right? So we have created a product that is almost a crowdsourcing to say from all the different places, when you boil it down, what is it that you're getting? What are the rules behind it? How much float does it have? How much, all the things that investors are really curious about, and bringing that together in one place. We have introduced that to the market. We have a couple of signed clients for that. And so we think that is something that can help the market. And eventually, as this grows, we think that investors should receive the same sorts of sort of routine disclosures like you would for a mutual fund or an ETF about how much you're paying and what's the performance and what are the other key parameters.
Hey, one thing I want to ask you, and we've been talking about this for, I feel like many years, Tim, in terms of, cheaper trading platforms, the digitization, the fintech that has certainly innovated, evolved over the last few years, maybe giving more individuals access to investing in the markets. Having said that, you still continue to see the wealthiest owning, the top 1% holding about 50% of stocks, the bottom 50% maybe holding only about 1%. So, democratization, has it really happened? Or what do you see as the flaws maybe in the fintech that has evolved over the last few years that maybe hasn't enabled more Americans to tap into the equity markets? I'm not saying it's the end all or be all, but for many it's a way to wealth. And is it just a case of Americans not being paid enough to be able to tap into it, or is there something around the actual infrastructure that's out there?
Yeah, it's definitely not the infrastructure, because Americans have more access to more products at lower cost than any place in the world, and that's been the vitalization of why American capital markets are so vital, and it's been a real growth story powering us. It's definitely true that there are big gaps between what the top have and what others have, but the number of people investing has been really going up. So the participation has been broader. And then the other thing I point out is when you look at the coming wealth transfer, and I know we've been talking about this for a long time, from the silent generation and the boomer generation to younger generations, that is going to spread this out a lot as well. And it's some as you know, tens of trillions of dollars. And those, when that happens, those newer, younger investors are using, they're investing in a very different way. And so as that wealth comes to them, you could see pretty big shifts in wealth management and the kinds of expectations that the investors that then in the future will have the money, the expectations they have. Wealth management firms need to get ready for that now.
All right. Interesting perspective. Hey, Tim, thank you so much. Great to get some time for you, or with you, I should say, on this Monday. Tim Gokey, he's Chief Executive Officer of Broadridge. As we mentioned, a company that not necessarily a household name, but certainly one. It's about a $28 billion market cap, up about 7% so far here, but certainly plays a critical part in terms of the financial services structure. So really interesting to get some time with him.
I'm driving in my car.
Hey, how about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, about 19 minutes to go until we wrap up the close here on this Monday. We want to mention, though, a story just crossing the Bloomberg coming from the Wall Street Journal. A consortium of investors led by Elon Musk is offering $97.4 billion to buy the nonprofit that controls OpenAI, upping the stakes in his battle with Sam Altman over the company behind ChatGPT. Let's not forget, Elon, one of the co-founders of this company, there's kind of a group of them, and he's been at odds with Sam Altman. Yeah,
I think at odds is a good way to put it, Carol.
I'm being diplomatic.
The Wall Street Journal's Jessica Tunkel and Berber Jin go on to report that Mark Toberoff, the attorney for Elon Musk, said he submitted the bid to OpenAI's board of directors Monday. Here's what that letter said. Quote, "It's time for OpenAI to return to the open source safety-focused force for good it once was," Musk said in a statement provided by Toberoff. Quote, "We will make sure that happens." It raises the question, Carol, that I have.
What?
He's got his own XAI company.
Right.
Why does he need OpenAI if he's got XAI?
I mean,
or why does he want it?
I don't know. Let's call Elon now and ask him. But what's interesting, too, is, Sam Altman has laid out some plans for OpenAI's future, and that includes converting it to a for-profit company and spending up to $500 billion on AI infrastructure through a giant venture called Stargate. So he and Musk have been fighting, and just again, the Wall Street Journal recapping this and what we have kind of talked about in terms of the conflict between Sam Altman and Elon Musk. So definitely a new development in the world of AI.
Is OpenAI for sale?
I don't know. Right?
Exactly. Yeah.
That's a good question. Yeah. So anyway, something to watch and something to add onto the list of things that we are watching on this Monday. It's just Monday, Lemon. Let's see what our next guest has to say about all that is coming at investors. Eric Freedman is Chief Investment Officer of U.S. Bank Asset Management. He joins us from Chapel Hill, North Carolina. Hey, Eric, it is good to have you here. Another Monday, another day where we are talking about potentially more tariffs, U.S. imposed tariffs against nations that are trading partners. I don't know. How are you thinking? How does this all kind of roll into the investment environment, and whether or not you feel comfortable enough to pull some levers here, or do you sit tight?
Yeah, Carol, thanks for having us on. We still think this is a glass half full outlook for us. I think the key thing with tariffs, it really rolls into the broader conversation about inflation, of course. And for us, we think that the barometer to really gauge is what happens with the U.S. 10-year Treasury yield. That has been, if you will, the governor of risk assets for some time. So right now, with the U.S. 10-year at 4.5%, we think we're actually in a pretty good spot. Above 5.25 on a sustained basis, that we think would be more problematic. So I think in general, you saw this a little bit from the University of Michigan data last week, as well as some of the chatter over the weekend and then today on tariffs, that the Fed doesn't necessarily care about what the source of inflation is. If inflation pushes them to raise rates, that 10-year Treasury we've been talking about, that becomes more of a problem. So if anything, that would be the common denominator we're most focused on, is what is the bond market telling us? And for now, they're at least placated with the current Trump plans.
What is the bond market telling us? It's surprising to see that it's not reacting more to tariff news. What does that tell you?
I think it tells us that there's a little bit of negotiations left on the table. You think about the dialogue with Canada and Mexico as perhaps the first salvo. That was a pretty big headline number. Then all of a sudden, at the 11th hour, there was a change in the news flow. So I think that what the bond market is saying is we actually want to see actually a finish line before completing our thoughts on, is this a done deal? So I think that because there's been both the Fed, which has said, look, we're going to be guilty until proven innocent with respect to the overall inflationary environment, and you've had this back and forth across global players with respect to tariffs, that we're not yet, completed, if you will, with a definitive view on tariffs. I think that's really why the bond market wants a little bit of optionality as opposed to making a definitive move here.
Is it safe to say that you're okay still investing in the U.S. equity markets as long as yields stay below 5%?
Yeah, that's very fair, Carol. I think if anything, we're seeing a level of participation from non-U.S. equities, which is certainly becoming more of a consensus long for people in my chair and other chairs. So, you have a decent global consumer, not so much in China, but Europe is in okay shape, not great shape. Again, as investors, we care most about marginal change. Are things getting better or are they getting worse? We think that in the U.S., things are really staying the same. And with respect to especially the European consumer, they're actually getting incrementally a little bit better. So if anything, we're still very excited about the U.S. equity market, even though valuations are stretched. Valuations never a catalyst, but we're seeing some improvements in trend data within Europe. We're seeing a still healthy consumer. That leaves us a little more excited about the international picture as well.
Where specifically internationally?
Yeah, I think if anything, to the idea, Tim, that things get marginally better before the news does. I think that Northern Europe, specifically Germany, is a decent spot to be. Clearly there's a lot of political back and forth with what may happen. We also think that if you look at some of the countries there's perhaps a little bit of an over-indexing about concerns on inflation. Think about a lot of the petrochemical countries of places like Brazil. Again, Brazil has been in a very tough spot. Technically speaking, Brazil is actually okay. And so I think you have those stories where the prices will move before the news does. And so, we think that Northern Europe is not a bad spot to be. We also think that some of the energy exporters is a good place to be as well.
Yeah, it's interesting. As much as we talk about American exceptionalism, right, we also talk about the high valuations here in the U.S. So if you're looking for opportunity, although people have been talking about looking overseas for a while, it is hard to ignore maybe some of what's going on overseas. Where don't you want to be in this market environment right now?
Yeah, probably the area that we're most, let's call it, concerned with in the very, very near term would be just the long end of the bond market. And we think that fair value for the U.S. 10-year is probably like 420, 425. So actually a little bit lower in yield terms, up in price from where we are right now. But we still think that next leg to get us excited about duration would have to be, a successive positive events on the tariff front. The one area that's really, we think, underloved, Carol, is that part of the bond market that not many people talk about is structured credit, more asset-based financing. Those are actually sporting some pretty interesting yields, and you can actually get access to them through a number of different, ETFs and other, hard to access managers. But, we think that in general, the long end of the bond market is still an area that we're not as excited about. Munis would be the exception to that. Structured credit would be the exception to that as well. Those are spots that we like more than just owning, boring old long U.S. government bonds.
All right, we're going to leave it on that note. Hey, Eric, thank you so much. Great to get some time with you on this Monday. Eric Freedman, he's Chief Investment Officer at U.S. Bank Asset Management, joining us.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.